Maybe 1% of the holder base actually gets out over 3x on that coin. What was the probability of success? Extremely low. You can't just go, oh yeah, this guy 100x my money, so now it's my turn to try it. It's like, bro, that was one guy out of 10,000. Like, good luck with figuring that one out.
And you have to remember that frame is only also one position. And so even if you're 100x, that it doesn't actually mean that you 100x to his net worth. It could be a percentage. And so you really have to look at it holistically from the view of what is the most simple and sufficient process.
Sad reality is that most people watching this aren't and will never be investors. They will just perpetually stay as gamblers. And you have to ask yourself, why do people who love 100x coins not have money? They don't have money because they're chasing the 100x, not because they don't have money and they're chasing the 100x.
Exactly. It's because they could make 100x, but then tomorrow they could lose it all as well. You have to multiply the probability of your decisions across a 20-year period. And the answer to those people is it's always zero.
Thank you guys for joining this video. Today I'm here with, I guess you would say 0x Kun. Is that how you say it? Is that correct?
0x Kun. Yeah,
Kun.
Or just Kun for short.
Yeah, so for context, guys, this is one of my favorite investors on crypto Twitter. This guy, you should be following him. His insights into the market are actually insane. Like what he says, every time I read one of his tweets, I'm like, this guy just said exactly what I've been thinking. He just put it better than me. So today we're going to be doing investing masterclass. We're going to be going over how you can get prepared for the next bull run. We're going to be going over the ETF, what that means for the market, and just some general investing mindset sort of processes that you all need to be following, because Kun approaches crypto investing incredibly professionally, and it's something that you very rarely see online. Most people, when they come to crypto, they're gambling. They don't take it very seriously. They've got no strategy, no process. They don't really know what they're actually doing. And so we want to make this video to give you an exact understanding of how you should actually be approaching investing properly with a proper strategy. And yeah, we're going to be going into this in a lot of depth today. So I think to start off, it would be really good if we had an introduction from you, Kun. So maybe give us some background on how you got into crypto, how long you've been in the space for, how have you done so far? And yeah, bit of stuff like that would be good.
Yeah, sure. Thanks, Dan. And thanks for having me. I'm a fan of yours, and I like people that are actually trying to teach people how to invest as opposed to just pick. So thanks for having me on. So yeah, I'm 0x_Kun on Twitter. I've been in crypto from about 2015. And my background's actually in software startups. So it was kind of like a natural leaning into crypto, being at the front end, like cybersecurity, in AI. And so that's how I sort of first got into tech and then into crypto. I've always been interested in investing. So before investing in crypto, I've been investing in the stock market, particularly tech stocks. And so that gave me a great view into hype cycles when crypto protocols, they say they're partnering with AWS, but really what they mean is they're using their compute platform. And so it just gave me a natural edge at the start. And so, that's how I kind of got into crypto.
I think one of the most popular talking points on Twitter right now is the ETF, and everyone has a different take on what the ETF means for crypto. And I saw a tweet that you put out and you talked about the ETF in a really positive light. And I wanted to get your more in-depth breakdown on why you think the ETF is good for crypto and what is your take on the entire ETF story?
Yeah, sure. So I think the ETF is actually positive in terms of the three different groups of people or buyers that will come into the market. At first, it's people that actually believe in the crypto space. They might own a little bit of Bitcoin, maybe they don't. They always kind of thought, Bitcoin could happen, but they didn't 100% believe it. And now that they're seeing that the Bitcoin ETF is coming out, they're actually thinking, oh, you know what? This has actually been talked about for a long time, but it's actually happening. So they're doubling down. The second group of people that it's going to onboard is after FTX happened and all these, couple bear markets have happened. Like most people right now, apart from people on CT, think that crypto still is a scam. They're going to wake up the day when Bitcoin ETF is approved. They're going to check the news and they're going to look at the price of Bitcoin because they haven't been checking. And they're going to notice that it's already up and that the CEO of BlackRock is talking about it in comparison to gold as a safe haven asset. And then they're going to get interested again. And so I think that's going to be huge. But the third one is where the huge upside is. And it's actually to people that don't even care about Bitcoin, who still won't follow Bitcoin, because the same way that there's like a passive bid in the stock market due to mutual funds, retirement accounts, once the ETF's approved and actually live, you're going to have like 0.5%, 1% of, different mutual funds, retirement accounts buying Bitcoin in ETFs. And so that 7-year-old guy, that 40-year-old woman that you see at the shops that don't even know anything about crypto, they're going to own Bitcoin. And so that across the next, 2, 3, 5, 10 years is going to be a passive 200, 3, 4, 5, $600 billion bid that is just passively coming into that market. And so that's what's really exciting. I just want to caveat and say that there is going to be a gap, I think, between when the ETF gets approved and the time it takes from there to actually for the ETF to come online. But having said that, we've also got halvening talks. So yeah, but as a long-term investor, it's very positive.
I fully agree, by the way. And I actually was thinking this. I had this like insight last week, and it's that concept of in the stock market, when all this new money is created, a significant percent of that inevitably flows into stocks. So if there's more inflation, more money goes into stocks. If there's less inflation, like there's still money going into stocks. There's that passive bid that we talk about. And crypto, because the onboarding is broken, that amount of money that is created that ends up in the crypto space is only very, very small, because it's very difficult to get money into the space. And most people think it's a scam. And because yields are high, most of the money that's created is still just going back into collecting that 3-5%. And so, like you said, with the ETF, it unlocks a passive bid. The amount of money that is created that will now be going into crypto is going to maybe 5, 10x, whatever the number is, from the amount that was passively going to flow in beforehand. It sort of like unlocks like the floodgates for a larger amount of passive bid to come into the market. Do you think that this passive bid is going to change the markets, the 4-year cycle nature of crypto? Do you think it's going to make crypto trade more like the stock market, for example? Like where it's more, yeah.
Yeah, I mean, I agree with you. And I think that Bitcoin's already separated itself from alternate cycles. Like obviously each cycle, it's the highs and lows have been closer together. And so I think that it will become steadier as we go on, because I give this example of like, you see what happens even for, people that just deal with altcoins when an alt is released on Ethereum that used to be on Solana or something, and it goes up 5, 10x. And that's from people just it can't be bothered to bridge. This passive bid, we're not just talking about inflation or like people putting in a bit of extra money. We're just talking about people that have, in many countries that have, superannuation or retirement accounts, they're not even having to do anything. That money is just constantly getting added into the market. And so it'll create a lot more steady inflows. And the type of buyers that are coming into the market, because of the nature of where that money sits, the sell side is also going to be lower than current. So I definitely think that over time it will steady and be more of a steadier growth than it is currently.
Yeah, because if you look at the type of mindset that a stock investor has and the way that they invest their money, it's very different from the mindset and the method that people invest their money into crypto. And the same person can have money in stocks and money in crypto, but they can have an entirely different mindset for both allocations of money. Like when I talk to people who invest in crypto, they view crypto as the degen bucket. And because they view it as the degen bucket, they take it with a totally different approach. It's much more about making money and then taking it out. It's like quick profits. It's like you're trying to dump on other people. you really view it as a zero-sum game. Where I feel like the stock market, it's a very different approach with the money that you put in there. It's more of like a 3-3. It's like, if we all hold this and we never sell, we can all make money because it will just go up forever. It's like a 3-3 mindset, I feel like, in stocks. And what I see, it sounds like what you're trying to say is that this stock mindset of less selling and more just holding for the long term, it's going to change the type of buyer that enters crypto and obviously the type of holder that ends up holding crypto. Obviously, there's the Bitcoin people who've been holding it for 10 years plus, and they are just the never sell type of people. But it sounds like we're going to get more of that type of person enter the market. Would you agree? Or
Yeah, absolutely. I think that kind of 3-3 mindset is going to come first for Bitcoin, and then we'll see how adoption goes and things go for other crypto as well.
Do you have any thoughts on an Ethereum ETF? Do you think it's going to be a bit trickier to get an approval there? Obviously, we don't want any predictions on like timeline, but can you see a future where an ETH ETF gets approved, or do you think it's too risky?
Yeah, look, I'm not an expert in that, so I don't want to make a comment as to whether I think yes or no. But I do think that off the back of the BTC ETF approval, speculation that the Ethereum ETF would get approved, plus because of previous market cycles, is going to bring back a lot of interest and into Ethereum, and that would cause potentially price to go higher shortly after that as well. But yeah, as far as when the ETF would get approved for ETH, I have no idea.
Yeah, it's the prediction side of things is anyone's guess. I try to avoid predictions as well. So, okay, so now we know Bitcoin ETF, it's a very positive catalyst for crypto. What is your actual strategy that you implement for crypto? Because I actually don't fully know this one as well. And I'm actually not even sure if you'd want to share it, but I'd be curious to know, and I'm sure the listeners would be as well, if you had a breakdown of like how you're approaching crypto. Not as much about like coin picking, but like, like a more strategy side of things.
Yeah, well, I always say picks don't matter. The main thing to start off with is, regardless of what you're investing in, the number one principle you always got to start with is you've got to invest with the belief that you're right, but position like you could be wrong. And so what I mean by that is when I invest in crypto, I start off with the premise of, okay, is there a world where Bitcoin fails? I mean, it's possible. So then you go down the line. Is there a world where Bitcoin fails and ETH also fails? Who knows? That might be possible. Then you have to say, well, okay, if crypto failed, is it possible that gold also fails? I don't think so. And so then I would say I would put my like retirement account all in gold miners stock, and then I would use that as a backdrop for my position before I even start my crypto positions. And the important thing about positioning as if you could be wrong is that when the market does test you, you need to be able to make sure that you've thought about all scenarios before you even start. Too many people in crypto and investing in general, they only ever think about the upside. But you have to think about the downside before you think about upside. And so once you start that thought process, that starts to lead to everything that you need to know. Because then you start thinking about, okay, well, what are my strengths? What are my weaknesses? If I had half my net worth in this and it dropped 20%, would I be able to sleep at night? No, I wouldn't. Okay, so what percentage would make sense? And then you think through this over and over until you get to a point where you've thought about the risk. And I say that it's like, managing a soccer team, or if you call it football, that, risk is managed in the game. You always have a goalie, you always have defense. You don't have you don't have 10 strikers on the field and then swap them off for 10 goalies once the market drops. So you have to think about this, all this stuff up front. And too many people think about it as, they only think about the upside and they think, oh, I'll manage the risk later. But in reality, all the risk is up front and all the returns are in the end. So I think, I don't know if that's a bit of a waffly answer, but you've always got to start from that premise. And then kind of like, you really need to focus on your, and so that leads to kind of focusing on your strengths and covering your weaknesses. So there's no one, I don't think there's just any one way to do it. If you're, for example, looking at, the quality of chefs, if you're not able to cook Michelin style food, there's no point trying to cook, some fancy ass dish. Just master how to put salt and pepper on the, steak and start there. And then, develop your skills, improve on your weaknesses. But yeah,
yep.
People just try to go from zero to 100. And that's what causes a lot of mistakes.
Yep. The metaphor I use is, too many people try to perform heart surgery when they could barely even put a Band-Aid on a wound. Like, people come into crypto and they try to be like a day trader or some like high level skill where you literally would have to be a heart surgeon level of skill to even be able to make money from it. And they don't even have the ability to just purely buy low, invest, hold, and then sell. Like, they don't even have the basic fundamental skills of just putting a Band-Aid on. And so, yeah, I agree. When you come into the market, people try to go super advanced too early, and they also forget that most of the money comes from just being able to put a Band-Aid on a wound. Like, most of the money comes from you just buying low, holding through the course of a bull run, and then selling towards the top. And this is how most of the guys who trade on Twitter make most of their gains as well. It's all the things that they did which they didn't really do anything for, which made them most of the money. And trading was always just this little thing that gave them a little boost. Like, they focus like 80% of their time on the thing that makes them only 20% of the money. It's very interesting. And so linking this back to what you've said, you talk about the importance of fully analyzing the situation, the downside, the upside, before you actually make an investment. So that even if price goes down, you know exactly why it's doing that, because you've already pre-planned for it. So you've analyzed the chessboard of this bull run. You've seen what you think is going to go good or bad. You see the downside, the upside. What do you like? What's your strategy? Like, how do you approach the market now? Like, how do you know when to buy, and how are you knowing when to sell? And when are you looking to buy and when are you looking to sell, for example, in your strategy?
Yeah. So the most important thing, for that, in my opinion, is that you always need to consider asymmetric upside. Like, so what does it mean for, downside to be less, than upside? It really means that the opportunity is asymmetric, that the downside might be 20, 30%, but that the upside is 10, 20x. So that's the kind of opportunity profile that I would want to look at. Now, what I would recommend personally, based on my own skill set or my own view, is to have 70, 80% of your position in Bitcoin ETH, and then have 5 or 6 bets in alts if that's what you want to do, so that any single position, it'll hurt if you lose it, but at the same time, if it pays off, it's going to be life-changing. Because it's not about are you going to lose? Like, we're all going to lose. If you pick 5 different opportunities, 3, 4, they may go down 20, 30%, they may go to 0. But it's not how many losers, it's the size of your winners against the losses. And so that's why I think that's so important.
Mm-hmm. I made a graphic of explaining that concept of, it's not about because in investing, without an edge, you're going to lose as much as you make. It's even. And your ability to make profit is your ability to raise to limit the amount of losses while also keeping the same downside. That's like, you limit your losses so that you're able to lose only a small amount, so that the profits are more than the losses, in a sense. So personally, my strategy for crypto is, I have systems which basically determine when the price is during some sort of capitulatory level crash, some sort of macro COVID sort of level fear. My data sets basically try to detect this, and then we look for entries there. And then on the upside, my process is basically waiting for that final eighth, where we feel like we're in the final eighth of a bull run, and then implementing a dollar cost average out sell strategy. That's my strategy. I don't know if you want to talk about what yours is for this bull run, or if you'd prefer to avoid that.
No. I think what's important is that people definitely not try to play the game of, I need to buy the all-time low and then I need to sell the all-time high, because it's just not going to happen. So like you said, you want to be in kind of the right order of magnitude, right? As opposed to trying to come the top. What a lot of people don't consider, especially in alts, is that if you look back at any of the charts where things that did do 20, 50, 100x, they all look like Eiffel Towers. Like if you did not get out within 2 weeks of the top, you basically are down 60, 70% off the all-time high. And without a process in terms of how you're going to do that, and that's why I think it's good that you have that process, without that kind of process, when it does drop in 2 weeks, people are just going to think it's a dip, like it's all good. And that's why most people end up round tripping and going down 90% from all-time highs. And so, you need to have, based on your portfolio, your goals, what is your exit strategy, and plan that up front.
Mm-hmm.
So and that's going to be different for everyone. And so that's very personal to each person.
Yeah, this is why alts are tricky, because the margin for error is significantly larger. Right? Like when Bitcoin tops, like you said, the range where you're going to sell is probably a lot smaller. The range of the volatility is probably a lot smaller than some tiny altcoin that just went 100x. So like you said, you have to have your altcoin outperform Bitcoin at least 3x, because you're never going to sell an exact top. You have to account for that margin of error where there's just so much more volatility. You're probably going to sell it after it's gone down 60%. And
exactly.
Yeah, that's a really good point.
And now, without a doubt, you're going to have people commenting or saying to you that, Dan, Bitcoin and ETH just don't have the upside that alts do. And that's true from a literal kind of like, you're looking at a chart and from all-time low to all-time high, yes, like without a doubt, alts are going to. But if you look at the reality of investing, the process in which you actually have to put money in the market and take the money out of the market and actually realize profit, it's just not founded in reality, because in the middle of a bull market, they'll say, oh, I've outperformed BTC ETH by 20x, and then 2 years later you never see them again because they're now down 95% and they got no money. And so you got to look at what is holistically the best strategy for the highest return over a longer period of time than just 6 to 12 months. And you can either learn that the hard way, or you can learn it by seeing what the people that have survived and made a lot of money in this space have done.
Yep. People love to use hindsight bias to say that they would be able to buy that bottom and sell that top, and they measure the amount that they'd make, measuring the exact bottom to the exact top, as if they'd be able to, in the future, predict that same thing, when in reality they can't. And the reality with investing is, even if you sell near the top, the fact that it was near the top and not the exact top means that there's a period of time where that decision will feel wrong. You will sell, and then price will go up above your entry, above your exit. So maybe there's 100 hours where the price goes up 30% from where you sold. And that 100-hour period, you're going to feel like you made the wrong decision. And that's why that process is really important, because if you don't have a proper process, you will view that 100 hours where price is above your exit, and you will go, oh shit, maybe I made the wrong decision. It's time to get back in. You'll buy back in. And actually that was the top. It was just a 100-hour delay from your exit. And you actually did time it quite well, but because you don't have a process, you fucked it up, right?
Really, exactly. And realistically, if something 100x, then from all-time low to all-time high, you're doing well if you get about 15x's out of that. Because if something was trending at 10, it momentarily hit $1 and went to 100, you'd be lucky if you bought that at $5 to $10 and then got out at 70, 80. But to do that, that's why I think for each thing that you buy, you should always have a thesis. Why am I actually buying this? And what are the reasons that are going to cause an increase in users, increase adoption? And people say that's all it means. But if you don't have that thesis up front, and you let the market dictate when you're going to sell, you just don't sell, because there's always, this is coming and that's coming, or, sorry, we didn't deliver on this, but, this is coming. And so your decision on when to buy or sell should be independent of the price. Actually, it should be based on, you buy for a thesis and you sell when your thesis is met, or you sell when your thesis fails. And so it gives you an independent entry and exit outside of just the price, because the price is just the price, and you're not going to be able to get in or out based on that.
Mm-hmm. And too many people, I feel like, focus on how much money they can make, and they don't focus enough on the actual probability of what you're trying to do, like to actually being successful. They will look at the guy who 100x his portfolio on, buying the bottom, selling the top, and they will go, I need to make that return. But they won't look at the probability of that scenario actually occurring successfully. That was one guy out of 100,000 people who actually hold the coin. And most people who hold the coin will lose money. So maybe 1% of the holder base actually gets out with over 3x on that coin. And only one or two guys maybe got that 100x. What was the probability of success? Extremely low. What's the probability of success of a 2 to 5x on Bitcoin or Ethereum, buying it, during the bear market when you can tell that we're in that capitulatory area, and then selling it towards the end of the bull run? That probability that you can succeed there is way higher. And yes, the returns are lower, but you have to account for the probability, the amount of returns, and also like previous success of implementing this strategy. Like you have to consider like multiple factors in the decision. You can't just go, oh yeah, this guy 100x my money, so now it's my turn to try it. It's like, bro, that was one guy out of 10,000. Like, good luck with figuring that one out.
And you have to remember that frame is only also one position. And so even if you're 100x, that doesn't actually mean that he 100x his net worth. It could be a percentage. And so you really have to look at it holistically from the view of what is the most simple and sufficient process in the way that I'm going to increase my total net worth, and not some kind of process and just trying to find picks that you think are going to 100x. So it's it requires a holistic approach.
So how do you handle volatility in crypto? Like if you enter, and let's say you're looking back in time, you bought here, price had to go down 20% before it went up, 100%. How do you handle that volatility in your investment process? Because obviously you're never going to buy a bottom. There's going to be periods where you lose. Losing isn't bad. That's just an impermanent loss. So like, can you cover that for me, that topic?
Sure. So I think volatility is the price that we pay, especially in crypto, to be able to make life-changing money in a shorter period of time. So you have to be very comfortable with volatility. You can trade, you can work really hard for 40 years and you're trading, your labor. Or you can trade in business, you're leveraging capital, you're leveraging your mind. But one of the biggest assets in crypto is being able to deal with volatility. And that is the psychological cost of making it in crypto. And so when you look at, like you mentioned, like 20% down, people get too caught up on that. But there's a big difference between volatility and permanent loss of money. Volatility just means that between point A and B, the price fluctuated. Permanent loss of capital is it went down and then obviously went to zero. So you have to consider those two things separately, because volatility in itself is not a risk. Mm-hmm. And so when people talk about like, I've got a good buy, but like I think it's going to drop 20%, so I'm going to sell it. I'm going to try buy lower. They don't realize how much complexity that they're introducing. Like firstly, you got to consider, taxes and all that. But more important, there's three different things. Like, okay, I sell, and it drops. Like, okay, are you going to buy 10% cheaper, 30% cheaper? At what price are you going to buy? The second thing is like, okay, but what if it doesn't hit that price? What if the price moves the other way? At what price are you going to buy back in? And so there's just so many different things that happen. Like if you go back and look at Facebook, Amazon and Apple, if you look at the chart, those little dips in volatility are an absolute glimpse on the chart. All you had to do was buy and basically, hold. So, yeah, my view on volatility is that it's necessary, and that's how wealth is made. If there's no volatility, then the ability to make a lot of money over shorter periods of time is diminished.
Mm-hmm. It's very true. And the other issue with selling to buy lower is that when you have that thought in your brain, that thought in your brain appears at the time when it is the worst time to sell to buy lower. Like, you never think, I should sell this to buy lower when the price is going up. The only time that thought ever enters your brain is near the bottom. So like people have it wrong. Like right now, I bet no one's thinking, I should sell this to buy lower. Like, everyone's thinking, oh shit, like I should keep holding this. It could go higher, beginning of the bull run. It might actually have worked now. Not that you should do it now, but it might have actually worked now. People think about, when people have ideas to do things in the market, it's usually the wrong time, because you should never listen to that first idea that your brain is telling you, because it's telling you this idea based on a feeling that you're having. And the feeling that you're having is the same feeling that every single person in the market is feeling. And if everyone in the market is feeling the same thing, it's the wrong emotion to feel, because you must counter trade the herd.
Yeah. Yeah, look, I totally agree with you. And that's why I tell people, like, if you're an investor, you should still know a little bit about trading and charts. And if you're a trader, you should still know a little bit about investing, because what happens is that when investors think, it's going to go lower, they don't realize that they're actually getting very bearish at support. And they don't realize they're getting very bullish, at resistance. And so they're like, just basic charting and understanding a bit of trading would help people understand that. But like, because people have no process, they're purely going in based on their emotions. The market is always going to figure out a way between A to B, from a low price to a higher price. For other buyers to come in, there also needs to be sellers. So the market is going to do everything it can to make you exit from your position. It's going to go up, 50% in a day to try shake some people out. It's going to go, sideways for 7 months to get people out who are impatient. It'll do everything. And so you have to think about all this up front.
Mm-hmm. And this is why I recommend to people to not be looking at charts all day and to keep busy. Because if you are focused on making money, it's a lot easier to weather the storm of the volatility. Because like you say on your tweets, you should be doing nothing like 90% of the time. You should just be letting the position play out. It's very hard to let a position play out if you have nothing to do. Because then you're just going to sit at home, look at the charts all day. You're going to be hyper-analyzing. Oh, I made $100 today. Oh shit, price is dropping. If the people who make the most money tend to actually spend the least amount of time looking at their positions. They just bought Bitcoin. Like, the guys who made the most money, not that you should do this, they basically bought it at like $10 and they literally forgot it existed. It just was left there. And you shouldn't do that. But it's like, from what I've seen, the best approach is that you need to keep yourself busy, focused on things that are important, so that you can allow that 90% of the time where you do nothing to take place.
Exactly. And what you are doing in that time, and why I recommend less positioned, is all you're doing is you're staying up to date with, is this tracking along with my thesis? And that thesis should not be linked to whether the price is up or down. It should be just tracking to your thesis. And that's what you're checking. And so your portfolio should only be as big as that you can manage and always be up to date with what you're invested in. Yeah, this whole, pick 50 coins and then you just, like, at some point it'll look great because you'll have this screenshot, that you're showing your friends, but like, that's never the amount of money you're going to have. So
yeah, what do you think of like spread betting, like those dudes who buy like 30 coins and they're basically just like, they're trying to be like a VC. They're trying to plant a bunch of seeds and hopefully one of them takes off. Like, why do you believe that VCs allocating to 30 new companies can do that strategy, but people in crypto can't do it for 30 different altcoins?
Well, obviously, if you're a fund, you've got like 10 different portfolio managers, or you've got all the resources to be able to do that. But just, and we're talking about individual investors. it's just going to lead to subpar returns. You can't possibly keep track of 20, 30. I like to say, like, how many friends can you stay in touch with and have like a grasp of like what they're up to? Like maybe like 3 to 5 friends, maybe 10 if you're like really social, like always going out. Like, how are you going to manage 30 positions? Like it's just not going to happen. And so they do it because they feel good, because they're like, oh, well, if some fail, it doesn't matter. But when you look at the actual return, where they can actually exit, returns are going to be subpar.
The only reason someone would want to own 10, 20 coins is just a lack of process. It'd be like a guy trying to date like 5 girls at the same time. You date too many girls, you actually end up feeling nothing for any of them really, because your brain just cannot handle that level of like that depth. If you're investing in 10, 20 coins, you're probably doing that because you actually don't really like any of them. Like you don't even have conviction on any of them. If there was one coin that you really liked more than the others, you probably would want to own more of that one. You wouldn't want to own only 2% of your net worth in that coin. You'd probably want to have way more in it, right? Like people, they find, well, this is what people do, I find. They identify like 10, 20 coins that sound good on Twitter. They buy them. They forget they exist. They don't keep up to date with the thesis. They lose money. Now they're bag holding because it was just a VC pump and dump and they bought at the wrong time. They keep the coin because they're like, oh, I have to recover my losses. I can't sell at a loss. And then they end up just holding this coin that they don't even believe in anymore. They've got no process, no conviction, and they just end up adding new coins to that existing pile, and the pile just gets bigger. And by the end of the bull run or during the bear market, it just becomes a pile of 30, 40 worthless coins that they don't even really care about.
Well, I'll tell you what's even worse than that. What's even worse is out of those 30, 1 or 2 are going to do exceptional, and they'll post on Twitter, I did 100x. But they'll sell those, and then they'll fund their losers to think it's like, oh, these other coins are going to go up later. So then they buy them, the bull market ends, and then they lose 95%. Because they're not tracking each project, all they're tracking is they open up their CoinGecko or CoinMarketCap, and they just look at their total net worth dollar. They don't actually look at each individual project because they just can't manage it. And so you end up into this really bad cycle.
Yeah. What do you think about that topic of like cutting losers versus should you cut losers or should you cut winners? What do you think? No,
you should never. Yeah. So you always let your winners ride. Always let your winners ride. And I say cut losers, but I just want people to make sure that they're not mistaking that price being down necessarily just as a loser. It's got to be cut based on your thesis. So if you're following through your thesis and it's not tracking, you have a objective and independent piece of document or whatever you've stored it in that says, okay, we have to cut because this is not tracking, and I don't actually understand. I don't understand the meta. I don't understand why it's behaving this way. And so you need to cut. Similarly, on the other end, if you have a winner in price and you're tracking along, that's great. But if it starts dramatically changing and it changes against your thesis or your thesis is hit, you also should be selling. And so, I just think that that's a crucial independent. You need to create some kind of independent independence from your portfolio so you can still stay objective. Because otherwise you'll just track with emotion.
Exactly. Because in general life, as a general like world life concept, winners tend to continue to win and losers tend to continue to lose, because a winner has a mindset which inevitably leads them to more winning, and a loser has a mindset that inevitably has a mindset like their mindset inevitably leads them to more losing. And with crypto investing, you obviously only want to pick winners, but sometimes you pick what you think is a winner, but they're actually a loser. And when you realize that, okay, this is actually a loser who's probably going to continue to lose, he doesn't have what I thought he had, you then have to reallocate and try to find another winner. That's at least how I approach it.
Yeah, and it's just about how do you turn that into a process. And so that's why I think if you have a thesis, then if it is a loser or you didn't understand it completely, you can then look back and go, well, what did I do wrong? Otherwise you don't learn anything, right? It's just like, oh, it's down, I'm going to sell it. But then you could go do the same mistake because then you just keep misinterpreting, the same thing over and over. And I see this on Twitter all the time, like, oh, this X coin, it's focusing on this privacy narrative. Oh, privacy went down, so I'm going to focus on the DeFi narrative. Like, they don't actually learn anything. And the problem is that if you keep doing that, like, no one is going to sit beside you and say, oh, you actually missed the fact that, you actually have to think about, usage or whatever other metrics, or it could be, how many, is this a fork? There's so many different things you have to think about. But unless you sit down and diagnose each situation, you'll just end up repeating the same mistake.
Yep. All these dudes like messaging me this week, like, hey, bro, I see the price is going up. Like, should I buy now? Like, I feel like I'm going to miss the train. They're asking the wrong question. Instead of trying to fix the problem, they're trying to put a Band-Aid on it. It's like, if you accidentally cut yourself in the kitchen, don't ask like, oh my God, like, how do I, like, oh, I need to stop the bleeding. Like, yeah, maybe like stop the bleeding for a second. But the better question is like, how can you not cut yourself in the future? Because otherwise you're just going to open another cut every time you go to cook in the kitchen. Like, how are you going to not miss the bottom or like miss an entry? What was the flaw in your process? Fix that. And then that will stop the problem from ever happening again. Because all these guys who ask, like, should I buy now? They're not going to fix the root cause of the problem. It's like, imagine you have weeds in the garden and you don't pull the weed out from the root. You just pull the weed that you see above the ground. Like, the weed is just going to grow back again. You didn't actually fix anything. Like, that, it's just like the totally wrong approach to crypto.
Absolutely. Yeah. And I know we're going to talk about this. I think, one of the biggest mistakes that newbie wannabe investors make is they think of investing as a outside-in process. They think, if I can just find the right pick, it's going to go up, I'm going to make money. But investing is really an inside-out process. And I don't think you can separate investing with the person that you are. And good investors, they tend to be almost stoic. And I think stoicism is probably one of the best, I think, philosophies for like investor type people. And so, yeah, it really starts with, am I prepared? Am I mentally prepared? Have I done the research? And then it's like an inside out process to then go, okay, what are my weaknesses and strengths? How am I going to apply those strengths? How do I cover my weaknesses? And then it's, you're working outwards. But the biggest mistake is they work outside in. And so, yeah.
So by inside out, you mean inside is the strategy, the mindset, the implementation. It's the things that you do and fixing your approach to crypto, and then looking out and applying the process, the mindset, the implementation to coins, which is the outside. Is that what you're trying to say?
Exactly. Yeah, exactly.
Mm-hmm. So what are some other of the biggest problems that, like the biggest flaws that people make on crypto Twitter, crypto YouTube? Like, what are the biggest mistakes you see people making?
Well, Dan, as you know, there's not too
like a billion.
Yeah. I think, I think when we talk about it, and I don't know if you're going to talk or share about this later, because I know we both feel the same way about it, but I think like the ultimate lesson in investing is that you need to buy low, right? And then you need to sell high. And you've just got to spend all your time on thinking, like, how do I actually go about doing that? But all the mistakes on Twitter, it's like something's gone up 3x. Okay, should I buy now? Or someone else is holding this, and so I should buy that coin. It's like two people can hold exactly the same assets, and one can be, profit, 10, 20x. Another person could lose 90%. So the actual pick itself doesn't induce the returns.
Yep. Because
it's the person like the pick is an ingredient, but the chef ultimately has to cook the dish.
Because every coin goes up in a bull run, you can technically make money on anything.
Yeah, and look, and it's not might all, but then it's like, yeah, how are you going to implement it? Because the person that's going to implement it decides when they buy and when they sell. And so, and that's why there's this hate cycle on Twitter. Like, there'll be influencers that promote something, it does 100x, and the follower says, oh, you're just trying to exit on me. And they can't really psychologically come to the conclusion that they don't realize that the pick itself is not what decided the returns. Mm-hmm. And so, I think that's fundamental, but like, there's just too many mistakes.
There's a lot of mistakes. I'm trying to there's so many that I can't think of any, but I have thought of one. One of the big, and I struggled with this one as well, and it relates to the picks thing. You go on crypto Twitter and you try to find accounts which are really smart and that are talking about particular coins that can do well in the bull run. And you try to find the best account that finds the best coins that is the most accurate. And the problem is, if you find a coin and it's talked about on crypto Twitter enough times, like 99% of those coins are actually not good. They're just good for a brief period of time. And your entry and the guy who's shilling its entry can be entirely different. And he can make money and you can lose money on the same coin, and it can be good for him and bad for you. And using crypto Twitter as your vehicle for finding these coins is not effective, because by the time that you get your entry from after they talk about it, it's generally too late, because people talk about the coin the most that's going up, right? The guy that's talking nonstop about Solana is the guy, it's because that's the coin that's gone up in his portfolio. So by the time you see it everywhere on Twitter, it was the outlier that went up the most. And then you're probably just going to end up becoming exit liquidity, because most of these guys talking about coins on Twitter are paid to shill, or they're a part of the team. For example, Hydra, I don't know if you saw that one. They basically just got a bunch of influencers to support the coin, and they just gave them an allocation. And the team of advisors looks really good because it's all these people from, crypto Twitter on the team, but they're not actually on the team. They're sort of just inside, they're just sort of like paid to be the front page advertisers, and they just end up exiting on, other people. And that's like what a lot of these crypto Twitter coins are. Like you see all these coins talked about. It's just the guy was sponsored. The coin's going well. He talks about it because it's going well. You see it. You think that because everyone's talking about it, it's good. You buy it, but you're actually just exit liquidity.
Exactly. And I think there's two parts of that. One is what smart people do at the start, dumb people do at the end. Which is, a big thing. And then the separate thing of, people always say like everything is just hype. So why does it matter? Like, isn't that how you should play if hype is what takes the price up? But the reason why you need to separate that is to exactly figure out, like, is this hype or not? Like, if your strategy is that I'm going to get in early on hype cycles, take a quick, long and get out. The problem is people confuse investing, trading. They don't know what the fundamentals are. They don't know if it is a hype play. Is it a fundamental play? Is it a combination? Like, you have to be very detailed as to what it is you're doing. And so, so then what ends up happening is everyone just ends up rotating from consensus to consensus, and nothing produces worse returns than doing what the average does.
Mm-hmm. What do you think of what do you think of the concept of outsourcing your decision making? Do you believe there's any level that you can sort of maybe copy people from crypto Twitter? Or do you personally do everything yourself, personally make up your entire thesis yourself, pick your coins yourself, whatever? Do you have any level of outsourcing?
When you're doing research, you're obviously... Yeah, sure. Yeah. I mean, when you're doing research, obviously you're going to read other people's content and things like that. So I structure my Twitter feed with people that I don't agree with as well as people I do agree with, so that as time goes on, I make sure that I'm not curating my feed to just feed my bias. And it's a big problem in the world today with news, like on Facebook or anything. It's like if you watch something, only things that are similar to that get shown. And so your sense of reality continues to get warped. So you've always got to think about how do I create a news flow or information flow that allows me to get both sides, and don't play the game of, oh, you're just angry this coin's up, or, your thing because the coin's down. Like, don't get into that, because once you start playing that game, you just get tied up with everyone else, and then you end up letting your emotions get the worst of you at the worst time.
Mm-hmm. What are you going to be looking out for in your process for your exit? Is there any data sets that you look at? Is there, how are you going to approach the exit towards the end of the bull run? Is there any mindsets or sort of strategies?
Yeah. So I'm a bit biased in the sense of, on entry, you do need to think about time horizons. And for me personally, you have positions that could be like Bitcoin and ETH that originally when you entered that you actually have decade-long thesis. And as long as that thesis tracked, you would hold on, because you're looking for exponential linear returns, not step up logarithmic, which tends to what happens if you try to always buy and sell on short-term horizons. But as far as alts go, when you start to see things going exponential in alts, when you start seeing Rolexes and Ferraris on the timeline, I wouldn't completely exit, but a good way to do that is you can then DCA your alts back into Bitcoin, because even if Bitcoin drops, you're always going to be up more in Bitcoin and ETH at the end of the bull market than you are if you're holding alts. And so that's a good example of not a perfect exit, but still going to get a much better exit over time than if you than if you're just trying to play this I must try to figure out how to sell at all-time high. And obviously there's many other things that go into it. But yeah, I think for followers and people that view this, it's really important that they come up with their own strategy, because the funny thing about exits is if you try to copy other people's strategy, what you'll end up copying is consensus on Twitter, and then it's not going to happen. So having a good strategy, having an excellent strategy with decent execution is much better than trying to attempt the other way around.
Mm-hmm. Yeah. You don't need to be perfect. Trying to be perfect will end up losing you more, because if you're investing over a 60-year time period, you're going to have to perform the same system, the same buy and sell many, many times. And a good execution will allow you to consistently do well over time versus trying to be perfect, and you're just going to end up fucking it up. You might be right a few times, but all the times you were wrong will lose you more than any perfect execution could make you.
Exactly. I mean, and the game of building wealth is, how do I build wealth over time? It's not me in 10 years showing you a photo of how much I used to have this one day 10 years ago. And so if you actually think about what is wisdom is the ability to see the long-term outcomes of short-term decisions. And so when you really think about wealth, how are you going to pass on wealth to kids? How are you going to make money? How are you going to still have money when you're 50, 60, 70, 80 years old? It's okay, you know what? It's not going to be possible if I rely on gambling and try to think of this as a lottery. I actually need to build a process that's going to allow me to invest across time, across markets. And so if you're serious about investing, then you come to that conclusion.
Mm-hmm. And the sad reality is that most people watching this aren't and will never be investors. They will just perpetually stay as gamblers. I run groups that teach crypto, and the sad thing is a lot of people still get dopamine rushes from degen related bets. We'll talk about, there'll be conversation about some sort of degen bet, and then I'll feel in the chat people go, "Oh, degen bet. Oh yeah." I can feel that certain people really love when you talk about the 100x coins. I'll do a video for engagement, the 100x coin. And the people who love the 100x coins are always the ones without money. And you have to ask yourself, why do people who love 100x coins not have money? Is it because they need the 100x to get rich, or is it because they're the type of person who wouldn't ever have money? Which way is it? It's generally the second way. They don't have money because they're chasing the 100x, not because they don't have money and they're chasing the 100x.
Exactly. It's because they could make 100x, but then tomorrow they could lose it all as well. So over time, you have to multiply the probability of your decisions across a 20-year period. And the answer to those people is it's always zero. So, that's a big problem. And actually, I just want to touch on the other, biggest kind of, mental problem that the people have. And it's when they put in money. Like the market is moving now, but you see so many people say, but the economy is so bad, and everything is going to the crapper. And so how could you possibly? There is a difference between reality and financial markets, because financial markets are always looking out 12 to 18 months. And so the worst time in the economy is the best time to invest. And when employment is rosy, everything's looking great, that's the worst time to put in money. And so you combine that bias of investing when it's rosy, looking for 100x, chasing winners, it's impossible to make money that way.
Mm-hmm. That concept you just said with the timesing your system's hit rate by 20 years is so valuable. That's a really good hack that people can take. Look at your approach. Come up with a probability of how many people succeeded in this. Like what's your success rate of hitting this? Times that by the 20-year time frame of you doing it, and then you'll find out the math of how you'll actually never make money, because you win so little times and you lose so much that it just counteracts any home run gain that you could have made. Like that's such a good approach, like such a good mindset hack.
Exactly, and people look at Twitter. Exactly. And people look at Twitter, they see that one guy that made like 9 figures. It's not actually, if you have 100 guys with 7 figures, then 1 or 2 guys just playing on leverage, just out of shit good timing, can make 9 figures or 8 figures in a cycle, because they've put all their eggs into one basket and they've leveraged long on 10x and they've just managed to go up. But then as soon as the bear turns, they lose everything. So you see so many people on Twitter that grew their accounts to 8, 9 figures, and now they don't even have 7 figures. So, so you if you don't think about the long-term game of wealth, then you're going to end up gambling.
Because certain strategies work really well in certain markets and really bad in other markets, and your ability to adjust that strategy depending on what the market environment is, will dictate, if you end up keeping that money or losing it. Like the guy who runs up a bag in the bull run, it worked because he was super risk on during the period where it was time to be risk on. And where he went wrong was he didn't adjust his strategy to account for where the market cycle was. He kept being the degen after the market had topped. He didn't listen to what the market was telling him and maybe just stop playing the game. This is another big thing that I talk to people about. Crypto is essentially a casino of sorts. And when you've hit the home run in the casino, the worst thing that you can do is keep playing. Like all these people, they make money in a bull run and their system never has a thing that says stop playing. They don't have a stop playing game. Like they never know when to turn off the game. Like in crypto, obviously you don't want to just approach it purely as a gambler, but there's a time to invest and there's a time to take off risk and relax and just sit back and you don't have to do anything. Like if there was a 1-year period where you had zero crypto exposure and you just sat back because everything was going too airy-fairy, rosy, good time, and you just chilled because you didn't see any great opportunities, that would be an amazing decision, but no one does that. I would say less than 0.1% of people could take a 1-year hiatus from crypto with zero exposure just to let things chill because you can see that the market's overextended. But it's that sort of approach which would actually make you way more money if you had the ability to just take a year off and just do nothing. Because you don't always have to be invested. You don't always have to be doing things. You don't always have to be risk on. Exactly. And so, there's so many different things we can talk about of how would you rebalance, and there's 100 different lessons to learn. Don't try to
don't try to chase. But that's why it all comes back down to, you think about, okay, what is the game of growing wealth? How do you buy low and sell high? And really think through that. And then you combine that with, okay, I'm the chef. What is in my mind that's psychologically holding me back? Or what am I thinking about the market's wrong? And you just got to be a problem solver, and you've got to work inside out, one of those issues at a time, so that you can and nut that out. So it's really, you got to focus on the specifics instead of just the like, you know, general things of, you know, finding picks and stuff. But it takes a lot of, if you're wise, you can learn that quicker. If you're not, it takes longer. But ultimately, that's the final lesson, isn't it?
Mm-hmm. And you talk a lot about comfy holds versus uncomfortable holds. I find that an interesting concept, and it was actually something I learned from you on your Twitter. You say comfy holds are the worst performers, as it means it's yet to test the conviction of its holders. I love that. I can completely agree with that. I'd love for you to expand on the concept of like comfy holders, and, you know, like, what is a good hold, what is a bad hold?
Yeah, and I don't want people to get too tied into the semantics. They'll be like, oh, well, I was comfy in this and it dropped 70%. I'm just saying that in general, when people say, oh, this is a comfy hold, they think everything's looking good. There's nothing to worry about. It means that I don't need to check if there's progress because it's just going up, which ultimately triggers the fact that they don't have a written thesis. They don't know what could go wrong. And so anyone, you know that it's going to go wrong when everyone is only thinking about the upside and not the downside. Whereas if you're, you should still have conviction. And I wouldn't say what goes up is necessarily, use the word uncomfortable, but it should, you know, when you do buy the position, you should feel a little bit sick in the stomach.
Yep.
Because all the returns happen when depressed prices swings from fear to greed, and then people chase. And that shift from fear to greed and those buyers that come in is what creates the higher prices. And so if you're comfy, it means you've swung on the speculum, you're at the greed side, and you're just about to become exit liquidity. And I'd like for everyone to think, the next time they think their bag's comfy and they think, you know, this is the one, see what happens after 6 months. Did something that, you know, is your smallest position that you felt sick about actually the thing that outperformed? And for me personally, it's always been like that. So
I guess you have to think about how strong is the type of buyer that now owns your coin. Because regardless of where you are in the market, there will always be a test of the holder base. There's always a test to see how strong that holder base is. And it's like good times create weak men create bad times, that concept. When the coin has been completely fucked with, like, for example, Solana, FTX crash, everyone hates Solana. They think it's a scam. The holder base was tested. Anyone who now holds Solana cannot be fudded out of their bag. There is no more news that could come out which could make them sell, because the weak people have gone. And it's like that statement, strong times create bad, or whatever it was. But like, the way it comes around is that the strong men create good times, right? The strong holders create upward performance, because no one is left to sell if everyone has been tested. And as you go into the greed cycle, you now get the weak hands entering. You get the pussies. You get the people who don't have conviction, don't have a thesis. They sell low. They swap between different coins. You start getting the tourists into your coin. And that's when you need to be concerned, because now you know that if there was ever something bad to come out in terms of the news or the macro, there's a lot of people who now would not pass the test of being able to hold a position. They would sell.
Exactly. Yeah. And that's why you should, but also that's why you shouldn't chase. And then if you just followed the right rules and you bought low and it dropped, you'd still be up. So you're okay. But the guys that chased, you get crucified. And so, if people can come back to those basics of, you know, having wisdom about long-term wealth and about buying low and selling high, and applying those every time they get too excited or chasing, oh, this position's just comfy, everyone would do much better.
Well, there's two types of pains in crypto, right? You either have the pain of buying when it hurts or the pain of buying when it feels good, but you feel the pain of losing money, right? There's only two possible pains. What do you prefer? Painfully buying?
Well, mate, that's so true. I like to say if it's it can either feel painful at the start and it'll feel good in the end, or if it feels good to buy, you're going to feel the pain later. So it's up to you which way you want to do it.
You're going to feel pain either way. You may as well feel the pain up front. Get it out of the way.
Yeah, feel the pain up front. Exactly.
Mm-hmm. All right. I think there was one more tweet that you did. Yeah. You talk about every financial lesson just boils down to the simple concept of buy a capitulation, buy low, and then sell high. That's like what it all boils down to. And that's what my investment system basically does. It's just like buy low, buy capitulation-ish, sell high. Like, how do you maybe break that statement down a bit more and how are you picking like when to buy low? What do you look for? When I asked you this question for when to sell, there wasn't too much specifics besides basically looking for like hysteria, mass hysteria, Uber driver talking about it. Is there something that you look for on your Twitter feed?
It's got to be written in your thesis. Yeah.
Yeah. What is your thesis for buying low? Is there anything that you look out for in your process? Like, for example, do you have certain crypto Twitter accounts that you use as like a counter trade signal? Do you use a particular data set? Is it more a hunch? Is it like a pattern recognition? You just know? Like, how would you say you know when to buy with your process?
Yeah, well, and this is key. And the key thing is that you don't know, right? And so you have to, like I said at the start, you have to be confident, but you also have to assume you could be wrong. And so when you apply that, you just have to keep thinking through, okay, well, how is it practically applied? And so, for example, with Bitcoin, when Bitcoin was at 20 grand, you have to think, okay, it can go 20, 30% lower, but in the long run, is Bitcoin dead, or or do you actually believe that Bitcoin at some point in the next 2 to 3 years is going to be above 20 grand? And so if that's the case, then why are you not even starting to buy, right? And what is the cost of you missing it and it going higher? Like, do you lose the asymmetric upside in that opportunity? Are you going to miss a 10, 20x because you want it 10% cheaper? So you have to really talk to yourself and be realistic. And coming back to, having a good execution. It doesn't have to be
doesn't have to be perfect.
100% perfect. You just have to have good execution. And people are going to say, well, it's easy to say buy low, sell high, but it's not like you can always pick winners. And that's true. Many, many, many times you can buy low and it's still going to go lower, right? But that's why you have sizing. That's why you have a portfolio. That's why you allocate more to Bitcoin. That's why it's important that you size your alt positions equally at the same percentage across a few positions, so that even if 2 or 3 do nothing, it only takes 1 to create order of magnitudes of return. And so that's why I say things like, actually, your small positions should be your bigger positions in terms of your alts, not large market cap. Because, people think like, oh, this small cap, I'm going to put in, X thousand, but this big, large market cap, I'm going to put in, 40,000. Well, actually, you haven't spread your risk. You own 5 tokens, but if just one goes down, you lose all your money. And so you need to, people don't really think about that. Whereas if you had 4 positions, equal weight dollars that you've put in, then even if one goes to 0, another one of equal size that does a 10x is going to more than cover that position and the others. And so if you look at most people's positions, though, they don't. It's like their first position's like X, second position is X minus 2, then X minus 3, and it's kind of this reverse triangle down, then really, unless your top 1, 2 positions do well, it really doesn't matter what happens with the rest of your positions. And so they haven't thought about that. And so, and I'm talking about the old positions, by the way, separate to the 70% Bitcoin ETH that I talked about. But yeah.
And often the altcoin that they are most bullish on, that they have the most money in, is the one that performs the worst, because they just basically went on crypto Twitter and they found a bunch
exactly. It's a consensus position. Exactly.
Yeah. And the consensus bet they allocate the most to.
Exactly. Absolutely.
So, and your concept of basically like spread betting of sorts, like have a few coins, equal weighting, one of them 100x's is cool, because if one of them dies, it's fine, because there's, you're hoping that one of them outperforms the rest. That concept works with a small basket because you have the mental capacity to handle 4 altcoins. This wouldn't work like we were talking about with the 20. Just for clarity, like if someone did 20 coins using the same mindset, it wouldn't work because you just don't have the mental capacity the mental bandwidth to spread it across 20 coins.
And then each win on a 20 coin bet has to do a lot more to cover the others. And so then what ends up happening is you buy second best, third best options. You start buying random things. And so, yeah, I just can't stress enough how important it is to really think through every single scenario. So, and this is different to everyone. But for me personally, for example, when I say like 70% in Bitcoin split 70-30, it's like, well, why is it? Why do I personally do it like that? Well, people say the beta on ETH is like, let's say 2x Bitcoin, right? So my assumption is for some reason, if Bitcoin died and ETH did a 2-3x, then that covers my loss if Bitcoin went to 0. Now I'm using extreme examples, but that level of thought process gives me the ability to be calm when the market is turbulent. Whereas if you haven't thought about it, all you're thinking about is, oh no, I'm losing money, like this is the end. And even if it is the end and everything was down, but I'm thinking, well, I've still got my gold positions in my retirement account, because if all of crypto fails, we still need a store of value. So what would that be? So like you have to wrestle with your demons, because if you don't, the market is a silent psychologist and it knows all your weaknesses.
Mm-hmm. Well,
it's going to be like,
imagine if you could go back in time to January and see that, or imagine if you could go back in time to when you entered a position and you saw that it went down 20% and then went up 200%. You would no longer care about the 20% because you know the inevitable outcome was 200%. That's what thinking about every possible scenario does. If you have considered the scenario, it's almost the same as if you'd gone back in time and you knew what was going to happen, because you've mentally accounted for that situation. So if it happens, you're not surprised anymore.
Exactly. And so that's why you need to think this through, because and I think this is really poignant about the market being a silent psychologist. If you haven't worked out your own issues, the market's going to figure it out for you. They're going to do everything they can. They're going to, like I said, go sideways. They're going to go up and down. They're going to go around to try to figure out, okay, what is psychologically wrong with Dan, with Kun? What freaks them out? And inevitably, you're going to get tested. And so ultimately, you get the returns that you deserve, because, someone might historically have a higher all-time high or whatever, but the money that's actually exited that you make was earned based on your ability to actually execute the whole process. It's not just a point in time.
Mm-hmm. What do you think about the concept? This might be the last question because we've been going for quite a long time, which is good. This has been really good. But what do you think of the statement, it's not a loss until you sell? Because I know you're going to have a nuanced answer here, so I'd like to hear it.
It's not a loss until you sell.
Yeah, because like imagine someone's lost 50% and they're like, I haven't lost money because I haven't sold.
Yeah, well, I think it comes back to all these things of it's not the absence of losers. So first of all, you shouldn't be scared of losing, firstly. And then you have to also consider, is it volatility or is this temporary or is this permanent? Like, are we talking, are we talking every member of the team has quit, the government has banned, or are we talking volatility based on one account, the market selling their position? So you really have to think about that, and then you have to think about, is it still following my thesis? And so with all these platitudes, you really need to then go back to first principles thinking, and then think about the specifics. And so the big platitude at the top of the wall says buy low, sell high, and then you've got to work your way down into the specifics until you get to the very bottom.
Mm-hmm. Mm-hmm. That's a very good insight.
So,
do you have any final thoughts or anything you wanted to cover? Anything that you think the viewers would like to hear before we wrap it up? Because I see we've gone for, I don't know, maybe an hour and a half, I think, which has been really good. If you had any final thoughts, and I'm going to bring up your Twitter as well to show people.
Mate, yeah, this has been great. And I know between you and I, we could chat all day because there's just, so many things. But yeah, I'd really like people to take away that you can't separate being a good investor with the human that you are. So if you want to be a good investor, you need to work on your mind. You have to become calm. Your highs and lows as a human being have to be lower if you're also going to be able to deal with the volatility in the market. And so you really have to know yourself well. And so the better you know yourself and how you deal with situations allows you to then create a process that deals with your weaknesses in the market. Otherwise, the market is going to find those weaknesses. And so, and I say this particular thing because everyone always focusing on picks. So, focus on yourself and think outward as opposed to the other way around.
Because the market will inevitably expose every flaw. For you to make money, every flaw will be exposed. So you either bring it out early or you let the market bring it out for you.
Absolutely.
Awesome. Well, yeah, thank you. I really appreciate you coming on this. This has been really, really good. We clearly have similar approaches, but you take things to another level, which is amazing. And I've just got on the screen, you don't see it, but everyone watching, you can see his Twitter account. I recommend you follow him. When he does tweet, they're very, very good. Sometimes he takes breaks, clearly just focused on living. But he tweets amazing stuff, very, very good insights into actually doing crypto properly. I think this is the only place people can find you, correct? Just your Twitter account?
Yeah.
Awesome. Yeah. So yeah, you guys should all give him a follow. Definitely worthwhile. And yeah, thank you guys for all joining. If you guys like this video, leave a comment below. I want to hear your feedback. We might do a part 2 if you guys like it enough. We'll see. Now, if you've watched to the end of this video, I want to say thank you, and I wanted to leave a little message for you. If you've watched this far, you probably realize that you've made a lot of mistakes investing. There's a lot of things missing in your process, in the way that you approach investing, and you need to fix this in order to make a lot of money this bull run. If you want the strategies, if you want the processes, the mindset, the further teachings, if you want to know exactly when you should be buying and when you should be selling, everything that basically we were talking about in this video, but in an implementable, practical fashion, then you should be inside of my mastermind. Everything that we talked about today are lessons and mistakes that we've learned firsthand from investing, which we've now fixed. And we now teach the process that doesn't have any of the mistakes that most people have been making, right? You can implement today the strategy, the process of people who have made all the mistakes already. You don't need to make all the mistakes and the errors that we talked about in this video. You can just today implement the correct strategy to buy low, sell high, pick the right coins, even though that's not that important, and be able to make money as a crypto investor properly. So if you want to do this, I run a mastermind community. I have 5 people I let on every single month. If you want to join, there's an application link below. Hopefully I'll see you guys inside. Cheers.